Good afternoon. As late in the day as we are, I will keep my opening remarks brief. We are in the final stretch, so hang in there. Hopefully the snacks will help. And we will have a string of codes and polling questions to help you get there. My name is Alan Kerwin. I'm a Deputy Director in the Division of Registration and Inspections and the Program Leader for the Broker-Dealer Firm Inspections Program. I'm based out of the New York office, and in addition to my oversight role in the program, I continue to provide direct oversight over a certain number of inspections every year. To my left is Kate Ostaszewski. Kate is an Associate Director, also out of the New York office. Kate spends a significant amount of time on various inspections, and she provides oversight over the review of audit procedures related to information technology, risk assessments, controls reliance, internal controls over compliance, on compliance reports, crypto assets, and distributed ledger technology. And more recently, she's spending time on developments in the AI space. And next to Kate is Mike Tanzosh. Mike is an inspections leader, again out of the New York office. Mike leads inspections of various firms with much time spent on one of the largest firms. In addition to his inspections responsibilities, Mike leads the team that drafts our annual report on the interim inspection program. Okay. As we have been doing in the other sessions, we are to provide a disclaimer. So the views we express are in our official capacity as members of our division, but are our own and do not necessarily reflect the views of the board members, or other members of the staff. Okay. So the topics that we will cover today include a brief review of PCAOB publications for auditors of brokers and dealers. We will present selected observations from our 2023 inspections and related requirements of PCAOB standards and illustrative examples. We'll provide insights regarding recent inspection results. And finally, we'll have a brief look at the status of our 2024 inspection activities. We now have a code for you to enter into your phone or notebook. The code is 536. 536. So a few words about the PCAOB website. The PCAOB website contains a wealth of information. And during these forums, we highlight various standards and guidance. And we really encourage you and your staff to become knowledgeable of what you can find on our PCAOB website. In addition to the standards and guidance, you'll find news releases, what is new, what has changed. You'll find proposing releases. You'll find concept releases, roundtable transcripts, comment letters. For example, on the NOCLAR proposal, there are just under 200 comment letters from various interested parties. And so there is a wealth of information. And this is an opportunity for you to involve your staff. It isn't just the partners and managers who should look at what has changed or what has come out at the PCAOB. You can actually get your staff involved. It's a great incentive for them to keep up with the changes. A question you can ask: how many times does your staff go to the PCAOB website to look at a particular standard? I can also ask the same question around the Exchange Act rules. How many times does your staff go back to Rule 15C3-1, 3-3, the account statement rule? We can tell on inspections how well we get a sense of how well the engagement teams are versed in the standards and in the Exchange Act rules based on their responses. I can tell that our inspection team staff look at our own standards every single day. We look at 3.1, 3.3 every single day during our work. That's how much we go back to that information. We do know that firms have methodologies and incorporate the PCAOB standards and to a certain extent provisions of the Exchange Act rules. But if your engagement staff is constantly looking at the detail of these rules on either our website or on FINRA's website, I think that says a lot for your engagement team. Okay, now, in terms of our publications, if you go to the PCAOB website or you just type in PCAOB broker-dealers, the web page on broker-dealer information will come up, and it's got a lot of information specific to audits of brokers and dealers. So all of our annual reports are listed. Guidance that has been published is listed. We even include the adopting releases from the SEC in 2013 on amendments to 1785 and changes to certain Exchange Act rules. So it's a great spot to look for information quickly. We also have staff guidance that was published in 2014. It's dated because all of our PCAOB rule references have since changed, but nevertheless the primary concepts are still intact. And it's a great primer for staff that are just joining your audit team or your engagement team on audits of brokers and dealers. Okay, what we'll be going through today, Mike will be going through the highlights of our most recent report that was issued in July of this year. So this deals with inspections that we completed in 2023. And Kate will be going over a spotlight that we issued at the start of the year around insights into audits of brokers and dealers. We felt that the spotlight would provide useful information to try and explain why the deficiency rates are as high as they are. Our annual reports provide statistics on where the deficiencies are, but the spotlight tries to explain perhaps how come we've got those deficiencies. Why are the deficiency rates so high? Okay, so with that, I'm going to turn it over to Mike to cover our report for 2024.
Great, thank you, Alan. Aside from walking through some of the highlights on the results, and again, all this information is sourced from our 4022 supplement report that we just issued this past summer. I'll also walk through some of the common scenarios of deficiencies we've identified in some key focus areas. So this slide has a lot of information, but I want to draw your attention to the first column here, which is the percentage of audits with deficiencies. This shows a marked spike in deficiency rate from 2022 to 2023 at 70%. Again, this represents at least 70% of the audits conducted had at least one issue. We also had high rates of deficiencies in examinations and review engagements, and I'll touch on those in a little bit later. One thing though to keep in mind when looking at all these figures, there is a different mix of broker-dealers and firms inspected each year, but nonetheless we do continue to find the same nature of comments each year across the focus areas. Here again is just some of the results by focus area, and again what jumps out here is the revenue line. So it's continually been the focus area with the most identified deficiencies, and it's a key driver of the overall results. Deficiencies here are observed across different revenue streams, whether it be commissions, advisory fees, or M&A. Common deficiencies included issues related to audit sampling, where firms have used sample sizes that were too small in substantive procedures because of undue reliance on control work, issues related to substantive analytics, and then auditors not adequately responding to the risk of material misstatement for each relevant assertion in accordance with AS 2301. The first scenario we're going to walk through illustrates a common presentation and disclosure deficiency in the revenue area. So first, before we get to the scenario, code will be 343. Okay, for our first scenario, again, dealing with revenue presentation and disclosure. So a broker-dealer reported commission revenue of $6 million in the statement of income. Commissions income comprised commissions from the sale of mutual funds of $2 million, mutual fund 12B1 distribution fees of $2 million, and merger and acquisition advisory fees of $2 million. And the broker-dealer disclosed the following in its notes to its financial statements. Commissions. Commission revenues primarily include commissions from the initial sale of mutual fund products and are recognized at a point in time on the trade date. So the polling question would then be, which of the following is true regarding the application of AS 2301 and ASC 606? The choice is A, the auditor does not need to evaluate whether there are distinct performance obligations related to the three revenue streams, since they are all reported as commissions. The auditor should evaluate whether the payment terms for revenue comply with industry standards. C, the auditor should evaluate whether the three revenue streams should be disaggregated into categories in the broker-dealer's financial statements. Or D, the broker-dealer's disclosures appear to satisfy ASC 606. Let's give it a minute as the votes come in. Still counting.
Can I just
All right, they seem to have slowed down. I'm going to advance. Great. The correct answer was C, which 70% of you got right. The auditor should evaluate whether commissions related to each of the three revenue streams should be disaggregated and separately disclosed from the others, both quantitatively and qualitatively. Two items I want to point here as far as the authoritative guidance is concerned. So ASC 606, paragraph 1055, states that an entity shall disaggregate revenue recognized from contracts with customers into categories that depict how the nature, amount, timing, and uncertainty of the revenue and cash flows are affected by economic factors. Further, in paragraph 90, it states that when selecting the type of category to use to disaggregate revenue, the entity should consider how information about the entity's revenue has been presented for other purposes. So in instances of broker-dealers, when we think of how information is presented for other purposes, the auditor should evaluate how their revenue has been disaggregated and presented in the focus reports to look for alignment there. So that's a key evaluation that should be made when deciding on whether or not the 606 disaggregation principles apply. Another scenario we're going to walk through is in regards to journal entry testing. Now, it was only an 8% deficiency rate in 2023 with journal entry testing, but it is an area that we increased substantially as far as our scope and the applicability of the focus areas. So we did want to cover a scenario here. So in this scenario, the auditor identified management override of controls to be a fraud risk. As part of obtaining an understanding of the broker-dealer's financial reporting process and controls over journal entries and other adjustments, the auditor learned that journal entries are not required to have descriptions. The auditor identified fraud risk factors in journal entry population, including incomplete journal entry descriptions, and the auditor performed procedures to test the completeness of the population of journal entries and observed journal entries both with and without descriptions. Okay. Polling question here is, which of the following is true? A, because journal entries are not required to have descriptions, the auditor would not be able to evaluate whether journal entries are accurate. B, The auditor should only select journal entries without descriptions to test. C, the auditor should inquire of individuals involved in the broker-dealer's financial reporting process regarding requests received to exclude descriptions from journal entries or to include inaccurate descriptions. Or D, if there's a large population of journal entries without descriptions, the auditor can select a sample of those entries to avoid testing the entire population. And again, leave the poll open for a minute. They're still coming in, but they're slowing down. All right. Great. Again, the answer was C, with 64% of your answer correctly. It's great. So again, because the auditor identified incomplete journal entry descriptions as a fraud risk factor, the auditor should inquire of individuals involved in the financial reporting process about inappropriate or unusual activity relating to the processing of journal entries and other adjustments. Okay. Here again is just a summary of our results related to review engagements. As you can see, the percentage has stayed flat year over year from 2022 to 23 at 40%, but it's still a concerningly high level of deficiency rates. All right, before we get to our next scenario, the next code word is 663. Okay. So common scenario from a deficiency perspective around AT2 reporting. So in this scenario, a broker-dealer files an exemption report that includes the following statements. It is relying on footnote 74 of the SEC adopting a release. It limits its business activities exclusively to underwriting and M&A activity. And throughout the fiscal year, it did not directly or indirectly receive, hold, or otherwise owe funds or securities to or for customers, carry accounts for or of or for customers, or carry PAB accounts. And the polling question there is, based on the scenario, which of the following statements would be inappropriate for the auditor to include in its review report? We have reviewed management's statements included in the accompanying exemption report in which the broker-dealer stated, A, its business activities were exclusively limited to underwritings and mergers and acquisitions activity. B, it did not directly or indirectly receive, hold, or otherwise owe funds or securities for or to customers, carry accounts of or for customers, and carry PAB accounts throughout the fiscal year. Or C, it met the identified exemption provision without exception. Again, pause for votes to come in. Okay. Again, the answer is C, and again, the majority got it right. Oh, no, we didn't. 37%. Okay. The key here is the term identified exemption provision refers to provisions in paragraph K of SEC Rule 15C33, which the broker-dealer would have claimed an exemption from under, right? So in this example, there was no identified exemption provision, as they were claiming, or they were filing under relief from footnote 74. So in this instant, it would not be appropriate for the broker-dealer to make, It would not be appropriate for the broker-dealer to make such a statement, nor should the auditor then refer to the statement about the broker-dealer that it did not make in its exemption report. And in this instance, again, statements A and B would be appropriate because they're accurately reflected in the broker-dealer's statement. Choice C would be the answer, as again, the term identified exemption provision relates to paragraph K exemptions and not to footnote 74. Okay. Moving on to the results from the examination engagements. Here again, you can see an increase in the percentage of deficiencies from 2022 to 2023 from 50 to 66%. Most of the issues here relate to testing the design and operating effectiveness of internal controls over compliance. We have identified deficiencies across the financial responsibility rules, including the reserve requirement rule, possession and control requirements, the account statement rule, and the quarterly security count. Some of the more common ICOC deficiencies involved testing of controls over completeness and accuracy of information produced by the broker-dealer or service organization used in the performance of controls, surrounded IT general controls upon which the effectiveness of other important controls relied, and controls over management review controls, including criteria used by manager to identify matters for investigation and how such matters were resolved. Okay, next code word here is 901. Okay. Our next and last scenario here involving ICOC procedures regarding the account statement rule. So here we have a broker-dealer that provides all customers who consent to electronic delivery access to their account statements in electronic form. The broker-dealer generates the customer account statements using information obtained from its internal systems and maintains the application used to store the account statements and make them available to customers, otherwise known as a portal. And the auditor determines that controls over electronic delivery of account statements to be important to the auditor's conclusion about whether the broker-dealer maintained effective ICOC with regards to the account statement rule. So the question here would be, which of the following is true regarding the auditor's responsibility to test the design and operating effectiveness of controls? Here again, the choice A, because the auditor understands that the broker-dealer's process is to make the account statements available to customers on the portal, the auditor does not need to test controls over the completeness of the population of customers who are to receive account statements. B, if the broker-dealer makes the account statements available to customers on the portal, regardless of consent, the auditor does not need to test controls over customer consent to electronic delivery. C, the auditor only needs to test controls over the completeness and accuracy of information included in the account statements. Or D, the auditor should test controls over customer ability to access their account statements via the portal. Again, pause as votes come in. Okay, looks like we've slowed down. Okay, here the answer was D, and the majority have gotten that right. Okay, because controls over customer ability to access their account statements via the portal would appear to be an important control over the broker-dealer's delivery of electronic statements, the auditor should test those controls, right? Very good. So supplemental information is required to be included in broker-dealer annual reports by the Customer Protection Rule and the Net Capital Rule. The Customer Protection Rule requires the presentation of supplemental customer reserve and possession and control schedules, and the Net Capital Rule requires the presentation of a net capital schedule. The percentage of engagement to deficiencies related to supplemental information in 2023 increased somewhat from 2022. The applicable standard here we're talking about is going to be under AS 2701, and generally these deficiencies fell into two broad categories. The first of which would have been insufficient procedures to test the completeness and accuracy of information presented in the schedule or supporting information used to produce the schedules. Second category was insufficient procedures to evaluate whether the amounts presented in the schedules were determined in compliance with the applicable rule. During 2023, we began a set of general inspection procedures to facilitate the consistent performance of review procedures on various topics from most of the broker-dealer audits reviewed. This slide summarizes the instances of noncompliance with PCAOB standards identified through those procedures. And as you can see, the issues mainly fell in four categories, whether it be audit documentation, the audit report, auditor communications, or auditor independence. With regards to audit documentations, most frequently involved instances where firms did not assemble a complete and final set of documentation for retention within 45 days in accordance with AS 1215. In regards to audit report issues, most frequently these involved instances where the firms omitted required elements of the auditor's report in accordance with AS 3101. With regards to audit communications, again, most frequently involved instances where the firms did not communicate to the audit committee or their equivalent all significant risks identified during their risk assessment procedures in accordance with AS 1301. And then lastly, as far as audit independence was concerned, most frequently involved instances where the firms did not provide audit committees or their equivalents required independence communications in accordance with PCAOB Rule 3526. And again, just want to point out, because many of the broker dealers do not have an audit committee, AS 1301 does provide a definition of the equivalent body. Okay. And lastly, as far as the results is concerned, we did identify one instance where a firm appeared to have provided bookkeeping or other services related to the accounting records or financial statements of the audit client. So as a reminder, we just wanted to say firms should be diligent in complying with the independence requirements of Rule 2-01C4I of Regulation SX. And further, broker-dealers should be concerned about with the potential noncompliance with the independence rules, because if the auditor's independence is impaired, then the broker-dealer has not satisfied the requirement to file financial statements audited by an independent registered public accounting firm. Alan, before I pass it to Kate, did anything come in related to the results? Okay. Next code word is 796.
That's 796. Alrighty, so we talked about the 4020T report, but now we're going to get into another document that is available for you, and we issued this in January of 2024, earlier this year. And the nature of this document is different because this is really an opportunity for us to provide you some additional insights that are not found in our annual 4020T report. And Alan covered some of this before when he talked about how this particular spotlight goes over some of what we're thinking about in terms of possible root causes for the high rate of deficiencies that we've seen. This is an example of a type of publication that we hope to continue to provide for you as it relates to the broker-dealer program in the future. So let me just move on and talk to you about some of the highlights from this particular release. So our first insight that is in this particular document is that what we view as a possible cause of deficiencies is that firms may have an insufficient understanding of the broker-dealer industry and the financial responsibility rules. And what gives us that perspective? Well, when we're in the field and when we're talking to auditors, we're seeing that they're not considering the applicability of certain rules that are applicable to the broker-dealer. We see that there's an inability to respond to what rule or what interpretation of the rule was considered when they performed testing of certain financial responsibility rules. We're not understanding or seeing that the engagement team has understood or challenged positions which, when we look at them, may be questionable as to the application and how the broker-dealer has interpreted the financial responsibility rules and their compliance with. So those things would drive us to think that perhaps there's not a clear understanding of the financial responsibility rules. Secondly, we also see evidence where the broker-dealer's operations are not clearly understood. And in particular, this relates to revenue and some of the discussions that we heard from FINRA earlier about their perspective as well, is that often when we look at work papers and when we have discussions with engagement teams and we're asking them about how they considered ASC 606, we do not hear or we do not see in the work papers evidence that that particular requirement has been considered. So for example, we don't see that the firms are considering who the customer is, what is the applicable contract, what's the transaction price, whether there's one or more performance obligations, and how those performance obligations are satisfied, and how that actually then aligns to what is disclosed in the financial statements as it relates to the revenue recognition policies. Now, we agree that sometimes it is a fairly simple revenue recognition given the nature of the revenue that's being recognized. But oftentimes when we see this, we see that broker-dealers engage in multiple types of business that really necessitate a detailed analysis of the ASC 606 principles. Another insight that we wanted to relay is we continue to identify instances where, from our perspective, there appears to be a lack of due care and professional skepticism. PCAOB Auditing Standard 1015 states that, among other things, that due professional care requires the auditor to exercise professional skepticism. So for example, some of the things that we see that management inquiries are performed, but that information is not corroborated by the auditor through other procedures. So there's a dependency on management inquiry alone. We also have errors and omissions in audit reports. So misidentification of the basic financial statements or supplemental information as it's included in the broker-dealer's financial statements. And we're also seeing that there are times when departures from generally accepted accounting principles are not identified. And usually these are more obvious errors, such as failure to acknowledge the application of new accounting pronouncements, such as the leasing standard, or obvious errors, such as cash flow statement miscalculation, misclassification. So I think we just want to remind, it's particularly engagement executives, that their role is an important role in establishing up front that all members of the engagement team should exercise professional skepticism throughout the conduct of the audit. Another insight we brought is that high rates of deficiencies may be the result of a lack of rigor in risk assessment and consideration of internal controls by auditors. Some of what we've seen, well, I guess let me step back and first say that risk assessment is so important to the process because it allows you to identify what you then need to develop an audit response for. So it really is critical in how much focus and attention you need to pay on certain aspects of the financial statements. So often, or frequently what we have seen in certain instances is that the auditor defaults to a control risk assessment of maximum. And again, you don't have to take a controls reliance approach. That's absolutely allowed per our standards. But in defaulting to that maximum for all significant accounts, we then don't see a sufficient understanding of the broker's, dealer's processes and controls being obtained in order to be able to understand how those transactions are initiated, authorized, processed, and recorded for significant transaction cycles. So if you think about what you need in order to be able to design your substantive procedures, is you really need to understand what's going on as far as those transaction cycles. Also, the auditor does still have a responsibility, even if they're not testing controls, to identify whether there is a significant deficiency or a material weakness in controls that needs to be detected and then raised with management. We also have seen that certain relevant external factors, such as economic conditions and changes in regulatory environment, and company-specific factors are not taken into consideration as part of the risk assessment process. And lastly, we also see that the auditors are very good at looking at quantitative factors in terms of determining the significance of accounts, but may not also consider qualitative factors that are important to think through in order to determine whether an account is significant and needs to be tested. The next area that I'm going to talk about is standardized audit programs. And again, standardized audit programs are great because they do provide you with a starting point in terms of understanding what the PCAOB standards are and their associated references, and then also providing you with some insight as to procedures that you may be able to perform. However, what we did want to recognize is that there can be an over-reliance on standardized audit programs. And what we mean by that is that those standardized audit programs do not get to specific facts and circumstances that may apply to your broker-dealer. What we've seen is sometimes these standard audit programs, for example, may remind engagement teams to select and test journal entries, but they don't get to talking through the depth of the PCAOB standards about all the different fraud risk factors that one should consider in order to design those tests to address fraud risk. Also, there may be limitations on the type of discussion of procedures that can be performed. For example, the procedures around revenue and testing of revenue might be written very generally, such that they can be applied to a wide range of revenue types, but the nature of the procedures that you may need to perform to test certain revenue types could differ. So the takeaway here is not that standardized audit programs are bad. They can be a very effective tool, but the procedures may need to be tailored and to be aware of the potential for over-reliance on those standardized programs without specific tailoring. The next insight that we have is on the EQR role, Engagement Quality Reviewer role. This is an important role. Per our standards, they are required to look at certain particular things. And what we've seen is that potentially in an effective engagement quality review can also lead to undetected audit deficiencies. Our view is that some EQR reviewers may not be sufficiently knowledgeable of generally accepted accounting principles or the industry, or they could be not reading the financial statements carefully enough, or could be reluctant to actually challenge the engagement team on certain matters that they have questions around. We have this view because we've seen multiple times insufficient audit responses in areas of significant risk, often revenue, and that's an area the EQR should have some visibility to. We see errors or inconsistencies in the financial statements. So we see supplemental schedules that don't agree with the financial statements, or we see internal inconsistencies. So the balance sheet might say one number, the cash flow statement says another number. So again, that is review of the financial statements is something that the EQR performs. And we've also seen errors and inconsistencies in the auditor reports themselves. So we've seen misidentification of financial statements. We've also seen mischaracterizations of management assertions in the attestation reports. So again, review of the audit report is something that the EQR reviewer has responsibility for. So often, or sometimes we see that firms think about possibly going externally to get the level of expertise they need in order to have a qualified EQR reviewer. I don't think that that is the only manner, though. I think that we do believe, and I think on this slide it says the internal firms can develop internally the right capabilities through more technical firm training, vendor sessions, conferences, and self-study to get to that level of expertise necessary in order to perform an EQR and not end up with undetected audit deficiencies. Okay, now we have a couple charts that are coming up. This one really shows, what it's trying to show is the relationship of the hours reported by auditors of the BD engagements that they perform in comparison to the number of clients that a broker-dealer auditor has. And the idea here is it's a way to think about experience. So is this possibly a way to demonstrate that a greater level of hours spent or more frequent experience with PCAOB broker-dealer audits could be an opportunity to show that there's a greater deal of experience retained within the firm. One thing I want to point out is the dark blue line, which represents engagements performed by firms that do not also audit public companies. And a significant number of broker-dealers that we review every year are performed by these firms. And as you'll see with the blue line, the dark blue, those firms we saw that they spent less than 100 hours on approximately 65% of the audits performed. We can't say that PCAOB compliant engagements cannot be performed in less than 100 hours, but we've certainly encountered many broker-dealers through our inspections that appear to have very straightforward business operations, but we've also seen broker-dealers with multiple lines of business and detailed financial statements and disclosures in this less than 100-hour category. So we do consider this a potential red flag. Again, not every firm must be a large firm to deal with broker-dealer clients that may be more complex in nature, but smaller firms with fewer clients need to make sure that they have sufficient experience as it relates to standards compliance. Here's another chart. This is to show the pace of auditor changes from 2022. Approximately 1/3 of broker-dealers audited by firms that we inspected in 2022 had changed auditors in the last 3 years. So again, an insight that we have is perhaps audit deficiencies could be higher because there's more frequency of change in auditors. And one knows that to start a new audit requires building expertise. And so again, is there a relationship there? Now, there's no maximum or minimum tenure that's most appropriate, but we do see the auditor change as an event likely to influence audit risk. So it will be a factor that we will continue to look at in terms of our oversight activities. The other thing that we wanted to just point out is we are seeing that some firms appear to take on more broker-dealer clients than they can adequately serve with their available resources, including partners. So something to be aware of. And also, some firms are growing their broker-dealer practices by taking on clients that from firms that may have been barred or sanctioned. And we just want to encourage firms that in those circumstances to be appropriately considerate of your client acceptance procedures and in assessing the reliability of your prior year financial statements and predecessor firm work papers. My last slide here is also a chart, and this is really going over audit fees and is there a relationship between audit fees and deficiency rates. This chart provides engagement fees for every audit firm inspected during 2020 through 2022. It does, however, exclude those firms that audited more than 100 broker-dealers or more than 100 public companies. Approximately 65% of broker-dealer audits we observed were performed for fees of less than $25,000, including 34% of less than $10,000 and 10% for less than $5,000. So that what this chart really illustrates is that the deficiency rates are high across all the fee ranges. And for the period since broker-dealers have been required to undergo audits and examinations, these deficiency rates have remained high. But the highest deficiency rates are in the $5,000 to $1,000 to $10,000 fee range, with 79% of audit engagements found to have at least one deficiency during the 2020 through 2022 inspection period, and compared to 89% during the period since we started doing our inspections. So these percentages do raise a concern that there could be that relationship between an audit firm's need to focus on profitability on such engagements that can then ultimately impact the number of hours and staff that is then allocated to planning and field work, which heightens the risk of audit quality deficiencies. With that, I'm now going to say that you need to put in your code word 542, and I'm going to turn it back over to Alan to be able to close out this session. We do have one question. What would be an example of the qualitative factors as it relates to identifying significant accounts? Okay, so one of it could be volume of transactions or volume of activity that runs through the account. So even though it might have a small balance as of year end, if there was a lot of activity that happened throughout the year, that might be something that you would want to consider. Also, the nature of the account. Certain types of accounts might be more apt to be something that you want to focus in on. In certain circumstances, suspense accounts might be of interest. Or error accounts might be something that has a level of risk that you want to consider that may not have a material balance in it. So hopefully that helps. Alan?
Thank you, Kate. We did receive another question related to auditor changes, so I'll spend a few minutes describing how in the BDF program we address this. So the question was, we've been to a firm and we inspected the audit completed by that firm, and in the following year the firm is no longer has that broker-dealer as an audit client. Will that firm be selected for inspection? The way I'm going to answer is that we consider the information, but for the most part, if a firm does not have any broker-dealer audit clients, we will not select that firm for inspection. So we do see firms that register with the PCAOB in anticipation of building up the practice. So for the first few years or first couple of years, they may not have any broker-dealer audit clients, and in the BDF program under the under the temporary rule, we will not select that firm for inspection. Someone might argue, well, you perhaps could go in and look at the system of quality control, but what we have done in the past is that we have not selected firms that do not have broker-dealer audit clients. If we take that a little bit further, and let's say we inspected the firm and reviewed the broker-dealer audit engagement and found a number of audit deficiencies. In the following year, are we going to go back to that firm and request information on remediation work that perhaps may have been carried out? What we do under the temporary rule is that we will focus on the new auditor, and as Kate mentioned, whenever there's an auditor change, there is a heightened level of risk for the firm taking on that account. For example, the firm needs to understand that account, understand the broker-dealer's operation. So there's a heightened level of risk whenever there's an auditor change. And under the temporary rule, what we will do is we'll look at different criteria, and we may decide to select that engagement in the second year, for example. We will not necessarily go back to the firm that has been released from that assignment to look at the remediation work. We will most likely wait until the new firm has had a chance to conduct its work. Now, that's not always the case. We may select that engagement in the first year, but that depends on a number of criteria. It depends on on our experience with that particular auditing firm. It might depend on our experience with that particular broker-dealer, that we may have inspected the audit under the prior auditor. So depending on a number of factors, we can decide to go in the first year or defer to the second year. We have gotten a couple of questions around the custody rule related to the Investment Advisors Act. So the Act of 40s, the 40s Act related to investment advisors. The question that we have received is, can the firm conduct that work under Rule 206-4-2? And if you look at the requirement for the rule, it requires that the firm be subject to regular inspection. So if a firm has no issuers, well, that firm is not subject to regular inspection. That firm is inspected under the temporary rule. So the interim inspection program of audits of brokers and dealers is not deemed to be subject to regular inspection. So this has come as a surprise to some firms. Now, the adopting release for 17A5 does address this when the broker-dealer is duly registered as a broker-dealer and as a registered investment advisor, and that the SEC will accept the report on internal controls over compliance as, I'll say, an equivalent to the custody work. So in those instances, the auditor, even though they're not subject to regular inspection, they would conduct that examination work on internal controls over compliance, and that is accepted by the SEC. But if there is no, if the auditing firm has no issuer clients, it is not subject to inspection. And under the 40s Act, that firm would not be qualified to assist with the custody work. So we have received that question. We've received a couple of more questions. They're fairly detailed, and following this forum, we will look at that and be getting back to you. So, so thank you for those questions. We have no further questions on our list here. So with that, this concludes our section, our session on broker-dealer audits. We'd like to express our appreciation to all those who have hung in there up until the very end. And we remain available for a few minutes after this session if you have any questions. So with that, we'll ask Brian to come back. Thank you.